This is the Debunking Economics Podcast with Steve Keen and Phil Dobbie.
The Archives.
Episode 166. Should we have tighter controls on money supply?
Now, I've spoken in the past on this podcast about the role of monetary policy, and is it in fact working? Can it stave off recession, for example? Well, today, another question: how much control do central banks actually have on the money supply? Given that the vast majority of money isn't created by central banks, it's created by commercial banks when they issue loans. So does there need to be more control on how money is created? That's today on the Debunking Economics Podcast with Professor Steve Keen. I'm Phil Dobbie. Well, money supply, you might have thought, is controlled by central banks. But of course, regular listeners to this podcast will know that that's not really the case. 97% of money today is created by commercial banks when they give loans. The other 3% is cash. And I suspect that proportion is going to dwindle away over the next decade as cash becomes even less important. So, Steve, I mean, this is acknowledged, I think, isn't it, by most people, maybe not the general public, but economists get it, you'd hope, and those who study this field. The Bank of England's pretty clear on it. If you go to an excellent part of the Bank of England website, which is called Knowledge Bank, there's a section there on how money is created, and they say most of the money in the economy is created not by printing presses at the central bank, but by commercial banks when they provide loans. And of course, a lot of those loans are for housing, aren't they? So does that mean when house prices rise too fast and people hold off buying, so that the demand for loans is not increasing as fast as the repayment on existing loans, so that means the money supply shrinks? If there's less money around, each pound is worth more. So don't we get deflation, or at least don't we get very low inflation at a time when we don't want that to happen?
A few interesting thoughts there. First of all, one of the reasons that the housing market is so bizarre compared to standard commodity markets is that the demand for housing will go up quite frequently when the rate of change of house prices goes up. People don't rush out and buy more carrots when carrot prices are rising. And the newscasters don't say, good news, carrots are up 12% this month.
Right.
But they do say that
That's
about houses.
because they're a Ponzi scheme, and we don't. Carrots aren't involved in Ponzi schemes.
So what you actually find is rather than the reverse relationship you're talking about applying in the data, it's the positive relationship. When there's a rising level of house prices, that feeds back into the supply of money, because people then the classic acronym FOMO, fear of missing out. And if you see rising house prices, you think, oh my God, I better get in now before it gets too expensive for the deposit that I've managed to scrape together. Yeah. And also in speculators, oh wow, here's the next rising asset market, let's get in there.
Right. Till we hit a crash though, till we hit a point where we go, oh my God, house prices are now just too crazy, they're going to start falling. Then everyone gets out of the market. That means less people are asking for loans, and then we see the money supply shrink.
Then what? I mean, this is one of those areas where the housing market requires very, very different analysis to any other market, with the exception of the share market to some extent. Though the share market is not as confusing again as housing, because there is if you imagine the standard just says supply and demand, supply is tight, therefore prices rise. That's about as far as the conventional analysis goes. Of course, that doesn't help, because as one of my colleagues, Cameron Pickering back in Australia, made the point that is an argument for volatility, not for house prices rising. Because if you argue if you think in conventional supply and demand curves, you draw your two lines on the page of paper. One of them is pretty much vertical, the other's pretty much sort of downward sloping, but pretty close to horizontal. You slide the downward sloping and up and down, you'll get large changes in price for small changes in demand, because there's no flexibility to supply. But it works both ways, so it doesn't really give you an explanation as to why house prices are rising. And what you see is people will twofold. They will see if house prices are rising at all, if there's any momentum to house prices initially. But if it just, let's say you have soldiers returning home from war, which was certainly the case back in the 1940s and 50s, giving a bit of a spike to house prices because they've got new monetary demand there, and therefore house prices start to rise and people think, oh, this is a trend, so I want to get in there before it falls out. I'm going to go and borrow money from a bank to go and buy into this rising house prices. Either what the negative motivation, fear of missing out, or the positive motivation, I'm going to make money selling my house because the house prices are rising. That feeds back to demand for money. Yeah, because this is the important point in the
and demand for money equals money supply, basically, doesn't it? I mean, banks are obviously there's upper limits, but they're going to create as much money as there's demand for.
This is the point that was first raised by Basil Moore, the person who gave birth again to the understanding that loans create deposits, not vice versa. And Basil's point was that there is the conventional analysis of everything in economics. They try to shove into two intersecting lines. But that's two. If you want to do economic analysis, throw 4 chopsticks on the ground. Make sure 2 of them form a perfect 90-degree angle. Where the other 2 intersect, that's the marketplace. That's about as far as the analysis goes. But what Basil said is, in the case of money, there is no independent supply curve of money, and the neoclassical economics tried to shove this into existence by saying, well, in fact, what banks are doing is simply intermediating between people who have money that they would like to. They've got 2 possibilities with the money. They can spend it, or they can invest it by lending it out to somebody else. And therefore, if you want to entice them to lend, then a high interest rate is going to mean they want to lend more. A low interest rate means they're going to lend less. Bingo! You've got a rising supply curve. That's the supply. And then the demand curve is the standard old story. The more expensive money, the lower the demand. The cheaper the money is, the higher the demand. Bingo! 2 intersecting lines. Demand's downward sloping, supply upward sloping, and the interest rate intermediates between the 2. That's loanable funds, or part of loanable funds. Now that is totally empirically false, structurally false, because. And Basil was the first person to regenerate this knowledge, because the knowledge did exist prior to people like Tobin coming along in the American neoclassical economists. And of course, the main pusher of this theory, and frankly, I think the word pusher is quite appropriate, is Paul Krugman. They push this supply and demand analysis. But what Basil pointed out is that banks create money simply by putting an entry in the asset column of their ledger, an extra. You come to a bank asking for a loan. They say, that's a great idea. Here's $1 million, Phil. Yeah. And then they put $1 million in your bank account, and then you use that $1 million to buy a house, which you couldn't otherwise afford to buy. So that is therefore the supply is what is equivalent to what the demand is.
Yeah, and that's, as I said in my introduction, that's commonly accepted wisdom these days, isn't it? That as I say, the Bank of England themselves is saying, hey, look, 97% of money is created by commercial banks. Central banks don't. Or the only influence they have, obviously, for central banks is their influence on interest rates. Now, I wonder how much that is overstated, because the interest rate is basically how much you're paying the central bank when you're taking money from them to put in reserves so that you can settle transactions between banks. But so if I buy from you, my bank has to pay your bank, and so that has to go through the central bank, and the central bank settles those transfers. So you've got to have money sitting in the central bank reserves, and that's the interest rate you pay for that. But I mean, that's only a small proportion, because if you've got first of all, a lot of banks are just trading between themselves without going through the central bank. And if you've got 2 large banks with an equal number of transactions in either way, then they're not going to need to pay any interest whatsoever. So the role of the central bank in that case is very minimal, isn't it? And who cares about the interest rate?
No, look, there's actually. I've got to say something which, I mean, you better. I'm happy you're sitting down, Phil.
Right.
You're sitting down?
Yeah, I am. Always.
You haven't got a cup of coffee? Okay,
I'm always sedentary. Yeah.
There's a good documentary from the Reserve Bank of Australia.
Right. Wow.
Okay, so I've said there's the second positive thing I said about the Reserve Bank of Australia, probably in my lifetime. The first being
we're feeling the love, Steve.
The Fisher and Kent analysis of the 1890s versus the 1930s in Australia, which is an exceptionally good analysis of why the 1890s was the worst depression for Australia than the 1930s. So there's two good things the Reserve Bank has done, and one is explain the role of open market operation, what they call OMO.
Yeah.
In setting the interest rate. So it isn't the fact you've got to pay money to get the reserves from the bank, to get reserves from the central bank, because when you have a inverted commas normal functioning system, banks keep reserves at the absolute minimal level they can.
Yeah.
Because it's just a cost for them. But with what they do once the bank has set a target interest rate, then it will use its capacity, unlimited capacity, to buy and sell bonds with the financial sector to ensure that the short end of the market, the 30-day, 3-month, 1 year bonds are trading within the band they set for interest rates. So back in the days when Voeckler set interest rates at something like 17%, that sort of that virtually defined how the public feels about inflation in those days, because bang, you got hit with this enormous interest rate because of high rates of inflation. That the real rate was actually quite small. In fact, it was often negative, but the high nominal rate was scarred into people's brains. That would be saying, okay, we're then going to, if the price of the bonds starts to rise, therefore the interest rates are falling outside the band we're trying to set, then we're going to get there and we're going to start selling bonds and drive the prices down again and push the bonds and push the interest rate back up. And so because they've got an unlimited capacity to do that, it's really the banding they can do with open market operations to control the fluctuations at the short end of the interest rate spectrum. That's what bonds.
But how does that influence my bank transacting with your bank and the cost of them managing those transactions? This
is one of the ones that it took me a while to get my head around why this matters, and I find a lot of my friends in banking, in the classic case of can't see the forest for the trees. Is that the right way? You can't see the trees for the forest, or the forest for the trees?
You can't see the forest for the trees.
Okay,
yeah, you're in the midst of it all. And I think that goes on a lot in the finance world, doesn't it? Because it's such a segmented world. Everyone does their job. They haven't really got an idea of how the system works.
I could get more obscene and say other things they can't see as well. But still, let's keep along with this one. What they would say is, look, we don't create loans. We borrow money and we lend it out. And they have friends who are involved in a particular Australian friend I'm thinking of here who is adamant about this point for some time. They said, we are always going out and borrowing money and then we lend. And I thought, well, when I do the accounting of that, you can't. That is only a margin game. If you're borrowing money and then lending it again at a higher rate, you're only getting a margin loan. You're not creating any money. It just doesn't make sense. What I realized was the type of borrowing that banks are doing is long term. They borrow long term. They might when you lend your money to a bank in this situation, you're locking it away. You don't have demand deposit as we have with our deposit accounts. You sell you buy a bond off the bank.
Yeah, for 30 years, for example.
That's right. Okay.
And in fact, in the United States, we're even talking about 50 or 100 years because there's no yield on 30
What that means is when you look at your equity position, you can count either the shares your bank has sold or the long-term debt the bank has as part of your capital or equity. And so the way that a bank operates is by having initially raising money either normally through a share issue, I've got a few friends who've started. Literally, I have friends who've started banks, and they will raise money from the Bank of FFF, Friends, Family and Fools, or they'll issue bonds from a company, and then that gives them long-term capital, and that goes into the equity, and they have zero assets and zero liabilities at that stage. They then lend against, they lend by creating assets and creating a liability at the same time, so their assets and liabilities rise. What they're doing is they're gearing up their equity. So a conservative bank might have, start with 100 million. With a 10-to-1 factor, it can create $1 billion worth of loans out of that over time, and then the payment of interest on those loans goes back to enhance its equity and so on. But fundamentally, when a bank is leveraging up its capital base, where its capital base consists of either shares or long-term debt. So that's why the banks borrow, to get the long-term debt that they can then lever up, and that's why they do the creation of money. So therefore, the cost of that long-term debt does factor into the cost of money they're going to charge out to you. So it isn't the interest
but only
rate
by a factor of 1 to 10. I mean, it's not all at that percentage rate, is it?
No,
I mean,
they're going to want to make it if they're borrowing long term at 3%, they're going to want to lend to you at 5 or 6. They've got their own costs to cope with as well.
Right, but if they're creating that money, I'm getting very confused by all of this, because they're creating that money. They only need to have that capital there in reserve, so if everyone was to demand all their money back, so that's why
it's not the reserve side, it's the equity side.
Sorry, a bad choice of words. And it's on the equity side. So, but they don't need that for all of my loan. They are creating my loan 10 times what they have in equity. So the interest rate that applies for that longer term bond only applies to 1/10 of that money that they're creating.
Yeah, they can. Then that's one of the calculations the bank will do. They are the only business which can lever up like that. And that's why banking is a privilege.
Right.
It's not just a power; it's a privilege as well, because you only get the capacity to act as a bank if you go through a registration process that says, "Okay, we're going to let you do this." And that, in that sense, it's just like the public spectrum, the radio spectrum. In that sense, it's something which nobody can own apart from the national government of the region, who can say, "Okay, we're going to auction off the radio spectrum." That's why we have radio stations are controlled in that sense. So should be banks. But once we've you realise you only have the right to operate as a radio station because you've purchased part of the spectrum off the state, which allows you to broadcast that frequency in that region. A similar thing applies to banking. You only become a bank if the authority, the national authority, says, "Okay, we've looked at your equity. You've got the equity we require. You look like you've got the management skills. The infrastructure is there. We're going to let you operate as a bank." But that comes with rights. That right should come with responsibilities as well. But people have completely forgotten that. So banks get away with blue murder. But yes, overall, it's the fact that they can lever up their equity base is something no other business can do.
Right. So basically, what you're saying is that this open monetary committee approach, which each central bank has, is working. They are, in effect, they're restricting the access to bonds. So they're buying bonds. They're restricting access. So they're pushing up either pushing up the price or lowering the price, depending on.
They're setting a price which they can control at the short end. They can't control the long end anywhere near as much, which is why I think we saw the famous inversion that occurred in America in the last couple of months, with the short rates being lower than the long rates being lower than the short rates. That to me was not the usual signal of a recession, but the fact that the Reserve attempt to push up rates at the bottom end was not being transmitted through. The central bank was seeing inflation in the future that everybody else was not seeing, and therefore the short rate went up because they can control it using open market operations. The long rates didn't budge, and you got a yield curve inversion.
Yeah.
But fundamentally, the bank does have the capacity to set that short rate, so they do have control over the price. But the point they realised when they were going through all the Volcker stuff about they cannot control the monetary aggregates.
No, well, I mean, because lowering rates, the assumption is that's going to encourage banks to create more loans and therefore create more money. But of course, we know that doesn't happen. Banks can't loan to people if they don't want to borrow. And right now, perhaps there's not a big appetite for borrowing.
And that's the issue. It comes down to what is the demand for credit right now. And I define credit by I've had a debate with some of my mathematical friends on this front. Matthias Griselli, the guy that I'm doing the work with on bringing energy into economic theory with, and he says, look, everybody else calls loans credit, and you call loans, and credit you call the change in loans. And my attitude there is we have such confusion in the whole monetary area. We need to get our terms right from the outset. So I define debt as the dollar value that is owed by anybody to anybody else. That is debt, which is denominated in dollars. I define credit as the annual change in debt. So one is a stock and the other is a flow. And if you look at the rate of growth of the money supply, because change in loans, which is credit, is creating an identical amount of money, then it's the demand for credit which is actually going to set how much money supply changes. And if you have the situation we're in right now, where in America's case, private debt is 1.5 times GDP. It peaked at 1.7 during the crisis, but it's 1.5 times now. At that level, the amount of demand for new debt is fairly anemic, and therefore you haven't got much credit demand. The money supply is growing slowly at the same time that the central banks would like it to grow quickly.
Right.
By dropping the interest rate, they can cover. But as you say, that doesn't work when people are carrying out large amounts of debt right now and are uncertain about the future.
So they've got no
control. They should be.
Yeah. So they have no control in that case. I mean, whatever central banks do, the instruments they've got, they're not going to do anything. Which I guess is why central banks are saying, well, we've gone as far as we can. The common voice from all central banks, or a lot of them right now, is we've gone as far as we can go. It's got to be fiscal stimulus. The governments have got to get involved now and start pumping money into the economy. It's almost as though they've been listening to this podcast.
Yeah, well, I think some of them are, but I would know. But let's not go there. This is hello.
Morning.
Mark Carney really surprised me on that front too, I must say, a few weeks ago, as we discussed. But yeah, what they've
not
realized
that he's listening to this podcast. It would be nice. Welcome, Mark, if you are listening. We'll get your name right as well.
There's a sense of impotence among central banks now, because if you look back historically, we go back to the Milton Friedman days. Milton Friedman persuaded central banks because they wanted to be persuaded. They're fundamentally neoclassical economists, persuaded them that the money supply was completely under control of the central bank, which is where the whole idea of helicopter money came in. The helicopter was an analogy to a exogenous system. So you have a market economy which controls goods and services. You have this exogenous system called the central bank that created the amount of money in the system. And because Milton presumed the economy was fully employed at the equilibrium level, then all the change in the money supply would do is change the rate of price change. So the simple formula Milton gave them was restrict the rate of growth of the money supply, which of course is under your control, and you will cause inflation to fall. Now, that was when you look at the way they drew the diagrams, they would draw these, again, this is chopsticks on the ground stuff. They drop one of the chopsticks vertically and say that's the money supply. That's parallel to the y-axis. And therefore we've got complete control over that. We can move it sideways. And because moving it out is going to make more money available, that's going to drive the price down. Then in that sense, they saw changing the interest rate as equivalent to changing the amount of money in the economy. So they put up interest rates dramatically under Volcker, up to from of the order of 5% to up there about 17%. What that did was cause a screaming recession, the 80s recession. And the argument that Milton gave that this was just because of a temporary adjustment as people realized the rate of inflation was falling. They'd have a temporary disturbance and then fall back to equilibrium, and there'd be no particular change in the real economy, but a huge change in the inflation rate. Instead, of course, we had one of the deepest recessions until the Great Recession. It was the deepest recession since the Second World War.
So how are we classifying money here? So in that introduction, I said 97% of money is created by commercial banks. By the way, that number, if you want to check on some of this, another credit to another central bank, the Bank of England's got this whole area on their website called Knowledge Bank. They actually say 79% of the money today is created by commercial banks, 18% is reserves in the central bank, and the other 3% is cash. Now, you've said how a lot of those reserves perhaps are actually sitting as bonds. No,
the reserves are cash, and the reserves are entries in the central bank's. And so that what that means is money,
nothing else. Yeah,
you can't actually spend it.
Yeah.
The only way that can be spent is if people take cash out of the bank, and then when they take cash out, then the reserves fall because the cash is no longer in the banking system. Yeah. So only if those reserves are manifested as cash and turn up as actual part of the money supply.
So they've got to make sure they've got that there, because they've got to settle all these transactions between the various banks and meet any demand, so that a bank doesn't fall short, basically.
Yeah. Oh, it's reserve settlements. I mean, and again, people think that reserve settlements have a control element over the banks. I believe there's only one country in the world, I think it's Estonia, which requires a bank to have reserves to enable transactions to occur. So if you go, let's just take a hypothetical situation. Your bank is running absolute minimum reserves. It's got $100 in its reserves, and you want to go and buy a new sound system for $1,000. in any other banking system in the world except Estonia, that would be approved. When that's fair enough, because you expect you've got $1,000. The thing is $1,000, you want to buy it, you hand it over, bang, it should go, the merchant should accept it, even though the merchant is banking at a different bank, so there has to be a reserve transfer between the two banks to make the thing operative. And that's what actually happens, because the banks are given, I think in America's case, 30 days or 45 days to reconcile the reserve balances, so they can be a negative reserve balance and still allow a transfer. No. In Estonia, that would not happen, because if your bank only had $100 and you had 1,000, it couldn't transfer the 900. The transfer would be blocked. Now, that causes such panic amongst the public when it does happen that most central banks say, we don't want that level of panic. So they let banks operate with negative reserves and give them up to 30 days, 45 days to actually reconcile their reserve balances.
Of course, a lot doesn't go through the central bank, though. A lot is, particularly if you've got a small number of very large banks with a similar number of transactions in either direction, they just settle amongst themselves, which is why we've got the interbank, the LIBOR, the interbank rate, which completely bypasses central bank. I mean, you'd assume it's at a similar rate to the rate that central banks are charging. Well, the markets would assume that they're going to be at a similar rate or a little bit below. But I mean, that's a problem as well, isn't it? Because first of all, it's another way in which central banks don't have any influence on the amount of money in circulation, or indeed how quickly it's moving. And secondly, it's a big disadvantage if you're a small bank, because you've got to work through the central bank, whereas everyone else is getting a better rate through LIBOR.
Yeah, I mean, the other technicalities there, but I think I want to come back to the money stock issue, because this vision that the central banks used to have their potency, that they could change the amount of money and thereby change the level of economic activity. Yeah. And then they got into the belief that they have the interest rates are the control mechanism, so they can affect people's preferences between consumption and savings by changing the interest rate. That became part of neoclassical economic models. So what are called dynamic, stochastic, general equilibrium models, which are neither dynamic nor general, but let's leave that issue out. They actually built a central bank into their models, and the central bank followed what's called a Taylor rule, where the Taylor rule pretty much said banks were targeting a 2% rate of inflation, and they'd put interest rates up 1.5 or twice as fast as inflation was changing to target that interest rate, and that would then set the equilibrium in the economy. So if they went from believing they could target monetary aggregates and finding they couldn't, because the banks themselves control money creation, to think they can control the interest rates. And then, of course, when the financial crisis came along, what did they do but go back and think they could control the money supply again? And I'm looking at an interesting little chart here, and people can have a look at it for themselves if they like, very easily. There's a brilliant database called the St. Louis Federal Reserve Economic Database, FRED. Have you ever seen that yourself?
Yeah, we have. Yeah, absolutely. We talked about it. Yeah, it's a font of all knowledge.
It's brilliant and very easy to control. So FRED has a survey which is called M1SL, which is M1 money stock seasonally adjusted. I don't know what the L stands for. And if you take a look at that chart, you can see the level M1, which is the money in checking accounts and demand deposits. Fundamentally, that was flatlining, not going particularly anywhere until bang, 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 the financial crisis, and now it's blasting off the stratosphere. I'd say the rate of growth has increased by a factor of 4. I had a guess looking at the chart. And actually, I can edit it to make it. Let's make it in terms of percentage changes here. Let's see. Trying to get, pardon me, I should be doing this live, but hey, this is our podcast.
That's the way we do it. That's the way this podcast works.
A percent change from a year ago. Let's just do that and go. Okay, yeah. The rate of change of money of M1 went from, before the financial crisis, negative up to 18% during the crisis, and then as high as 20%. In November 2011, it's now fallen back down again to around about the 3 to 5% mark. But that's not working either. That was the result of the Federal Reserve trying to pump up the money supply through QE and so on. And they're basically saying nothing we do has any effect.
Well, I mean, that's interesting, isn't it? Because it all depends on the type of money that is created. Because if I get a loan from a bank, that bank has created the money, but if I then put it into a long-term investment fund and I can't get access to it for 5 years or 10 years or whatever, is that still money? It's not in circulation. It can't be spent. And similarly, if I buy a house, that can't be sold. Well, it can, but not in a hurry and maybe for less money than I paid for it. So liquidity is a big part of this. And I could take something which is very liquid, the money that is being created by my bank, and make it quite illiquid, couldn't I?
Yeah, yeah. Well, that's what you do. But of course, the person you lend the money to puts that money elsewhere in the system. So there's actually a transfer of money. It goes from you to the financial sector. It's not a case of the money disappearing or going out of the money supply, but it turns up elsewhere in the system. And what you then get is you get all these classifications: M1, M2, M3, M4, and finally they just gave up. You actually, I think the Federal Reserve stopped recording M3 and broad money 10, 15 years ago. So they simply, not only do they find they can't control the money supply, they can't even count it. And what has happened as a result of that is that they've just basically abandoned monetary targeting completely. But the wisdom that comes out of that, the 2014 Bank of England paper, which is wisdom of 50 years of post-Keynesian economic theory and research, I might add, that wisdom tells you if you want to measure the change in the money supply, measure the change in debt, because that's what's creating the money supply in the first place.
Right.
Where it ends up in the system is another story, but you can very accurately measure how much money is being created by measuring change in private debt, which I call credit.
And does it matter? The question I wanted to ask you was, how do central banks have more control over the money supply? But does it matter? I mean, if a commercial bank lends out too much, then they're going to end up having to pay more because they have to borrow more from the central bank. So they're going to have to pay higher interest rates. And obviously there's regulations as well about how much they can create versus the capital they hold. I get very cautious about using the word capital versus equity, but I think it is capital that they hold. So I mean, central banks have sort of like a regulatory influence, and they have an influence on, if you really are getting yourself heavily into the red by creating way too much money, then it's going to level out at some point, isn't it? They can't go on forever. So long as that we've got those controls, and we've got the fact that if you create too much, then it's going to start costing you more. The incremental cost is going to be too high, and secondly, we're going to regulate you anyway. Then perhaps we shouldn't be worried about it.
No, I think what tends to happen instead is you're quite right. The one way that the central banks control the private banks do, or the government could, is by regulation. But of course, a huge part of what's come with the whole market is deregulation. Let's let them self-regulate.
Right.
Let's let them.
Well, okay. Let's go to that first point then. If I create a lot of money, then I need the I need to back that up somehow. I'm going to have to pay for the money to back that up. And so the more I create, the more I'm going to have to pay. So my money becomes more expensive than somebody who's not creating quite so feverishly and doesn't need the same level of reserves.
That's exactly the mechanisms Austrians think apply in the market, which doesn't exist.
Right. Okay. Well, at least I put it out there.
Yeah, it's important to put it out there. But what tends to happen instead is that the control mechanism is actually the willingness of the banks to lever up the equity base they have. So if you start from $100 million and you're willing to have a 10-to-1, then you can create $1 billion worth of money that way, and you make your profit on the creation of money plus the margin you're charging of your cost of capital. But if you have willingness to go to 30-to-1. Then you do a hell of a lot better. However, you are then very exposed to the volatility of your asset base. No. Now, of course, what we saw during the financial crisis, and this is one of my favorite lines in economics, by the way, was that Hank Paulson, I think Hank Paulson was Goldman Sachs himself initially, wasn't he? Morgan Stanley, I think it's Goldman Sachs, the vampire squid bank. He became Treasury Secretary. And then when the financial crisis hit with vengeance in 2008, it began in 2007, but the market started to fall about in 2008. He got a call from his previous company saying, look, you've got to do something or we're going to go bankrupt. And Hank Paulson asked, how long have you got? And the answer was about 3 hours. Now, the reason that it was so dire is that when banks create the loan, of course, they then, with their own finances, they will then buy and sell other financial assets as well, trying to get more leverage on their asset, on the income earning on their asset side, and so on. They'll have a diversified portfolio that can include shares and shares in other companies for that matter. Other banks for that matter. If you then have a stock market plunge and the value of those shares goes down straight away, as soon as the asset markets fall, the price falls, and you've got to then record a fall in your value of your assets. Your liabilities are remaining constant. What takes the hit is your equity or your capital. Okay, so that's the thing which catches them out is not that it gets more expensive to do it. There's not a price regulation going on there. They'll get caught up in a euphoric period where they're going 10 to 1, 15 to 1, 20 to 1, 30 to 1 leverage, and then bang, the asset markets go in reverse and they're driven back.
So how does central bank, because another role of a central bank obviously is to ensure that there is, the banks don't collapse, that there isn't too much risk being carried in the banking sector. How do they allow that to happen? Why don't they say, well, money that you've got in reserves, you can sit with bonds. It can't be any high risk capital.
That used to apply. Again, this is one of the regulations we used to have, and I've forgotten the actual expression for it in Australia. But
common sense?
Yes, that's a good start. Okay, but hey, listen, common sense and economics. I mean, please,
I know. We're talking.
They're not even saying the side of the same phylum.
We're breaking boundaries here, but I mean, it does get down to regulation, doesn't it? I mean, if we're taking regulations away,
LGS was the initial. Local liquid and government securities. Yeah. They were required to keep a certain percentage of their assets in that, no matter what, and that was one of the many regulations abolished in the deregulatory frenzy that Milton Friedman fundamentally set off with central banks, and then the economic profession cheered them on in the whole process. So all these controls basically said, let's let the market decide. Our interventions will make the system less market-based and therefore less efficient. And the whole focus upon efficiency ignores another essential element about survival, and that's adaptability. That's diversification. That's resilience. And if you're perfectly efficient, you can be totally lacking in any resilience whatsoever. And that's what the banks got themselves into because, again, unlike any other business, they can lever up their capital base and make money out of the leveraging. No other bank business can do that, and they should be controlled because that is basically a bucket of money that they manage to profit out of as Richard. By the way, Richard, I know you're listening. We've got to interview you sometime soon. Let's get together and Phil and work this out, have a conversation, a three-way with you.
Okay.
That capacity to create that money is such a temptation. They all fall for it. They all get caught up in euphoric loans. The euphoric loans fail, and then bang, the asset base collapses, and you have a financial crisis. That tends to be how banks are regulated.
Right, but even before that financial crisis, let's look at the situation where we're in now, where we have very low inflation and very low interest rates, and everyone is wondering, how the hell did we get here? How do we get out of it? How much of that is because banks are just creating too much, or in the past have created too much money, and how much would more banking regulation solve that?
Well, that's exactly what got us into this problem. Again, there's far too much private debt. Again, back to Richard's campaign, the private debt campaign, we've got to reduce the level of private debt. He and I have got different ideas about how to go about that. But because banks create money by creating loans, and because the level of loans they create end up affecting the salaries of the share revenue of the owners of the bank and the staff of the bank, you get caught in euphoric bubbles that you have us creating too much debt, too much money, and then a financial crisis and a crash.
But regulation could control that. So we could say, well, okay, we're going to make it harder for you to create money. That is going to keep a tighter control on the money supply, and that's going to be a healthier situation.
The trouble is then, again, people say, look, you're restricting commerce. So they get all these sorts of problems out of it. I think the only way to go about it is really to restrict the capacity of banks to lend into what are fundamentally Ponzi schemes, of which housing and shares are the two most obvious examples, because it's lending for those where again, back to what we started talking about, the demand for those assets rises when the rate of change of price of those assets is rising. So you get a positive feedback that actually leads to an amplification of the creation of money, and then a crash because a large part of that money is created, as Richard's book explains so well from his own experience inside the banking sector, garbage loans.
So you're almost talking about two different types of banks, aren't you? Or at least segregating the way banks operate. So on the one side, you're saying, well, okay, we'll give you loans for your house or whatever for non-productive productive assets, and we're going to control the amount of money supply that can be created to support that. On the other side, we'll have a whole different model that applies to productive loans.
Yeah, and that sort of we need a sort of structured, diversified financial system, the financial system will not do it itself because there will always be herding. When there's money being made in real estate, everybody lends into real estate.
You've got an asset there sitting there, so obviously, it's a no-brainer.
Richard will give when we get him on the podcast, we'll give a beautiful explanation of how that led to his becoming a significant banker, because everybody in Texas. But every bank in Texas was lending to oil rigs when the oil price went from $10 a barrel to $40 back during the second OPEC price rise, and then the oil price collapsed. Now that's herding by bankers, and if any mob herds, it's bankers. That is a sort of behaviour that comes out of the market system when you understand it properly, not this pair of intersecting chopsticks, but that the real world, particularly the real world of money creation, you can't let banks do that herding. You've got to have a structured ecosystem of banks.
I'm just typing in collective noun bankers into Google to see what it comes out with. A herd of bankers. Close. A wunch of bankers.
A wunch.
A knot of Scottish bankers. There we are. A wunch of band. I'm not sure. I hope it's not too rude. Look, we'll leave it there for now. We will catch you again very soon. Thank you, Steve.
You're welcome, mate.
There we are. Clear as mud. I think we might have to revisit this topic a few times, mightn't we, to try and get to the bottom of it all. But I hopefully you get the gist of the idea about the way banks work and create money and the influence that it has. And that is it for this time on the Debunking Economics podcast with Professor Steve Keen. I'm Phil Dobbie. We'll see you again next week. Thanks for listening. If you've enjoyed this podcast, then please share it with your friends, like it on YouTube, and subscribe to this channel.